Ogunkoya, a research analyst at ARM Securities, now joins me from Lagos to discuss the drivers of these earnings and what to, of course, expect in the next quarter. Janet, a pleasure to have you join us on Closing Bell West Africa. What do you make of the Q1 earnings that we have been seeing across cement companies at this time? What do they tell us of the cement sector?
Hi, thank you for having me. So, for the cement sector, so far, particularly in Q1, coming into the year, we actually had, broadly positive outlook for the cement industry coming into the year because, Q1 last year had a low base, but all of that was disrupted with the pandemic that came up, unfortunately. However, the results that we're seeing largely positive as far as domestic consumption is concerned. So, you see the likes of BOA, for instance, they had a new capacity come up in Q2 last year. So they've had quite that big jump in terms of that revenue growth because of the volume that they recorded from last year. And then the likes of Dangote Cement as well, even though they had an Africa business, because they have wider reach, so they had an Africa business to actually talk on their top line growth this in Q1, unlike BOA. The likes of WAPO, for instance, also recorded some good top line growth in Q1 as well. So it was broadly positive as far as the domestic market was concerned. So we actually saw that growth coming, before, we started to see, like I said, before the coronavirus pandemic, I started the lockdown came up, late in March. So we didn't see that actually affect most of the top line growth. However, it was what we've actually seen as a common trend among the three players has been some erosion in margins because of the pressure that they've had on costs, mostly because they've had the valuation to increase the cost of production. So we've had that margin erosion across players. So as far as top line is concerned, we had some good players in Q1.
Now, clearly, no doubt, like you mentioned earlier, Janet, the pandemic definitely was an issue across board for all the companies that turned out their results for now. But having looked through the results that we've seen so far, what would you say, or were there any areas that particularly constituted high points for you as far as the cement sector is concerned?
Yeah, so like I mentioned, of course, all three companies, the three major cement players, have a unique issues. We have the likes of Lafarge having some low finance costs because of their South African business, that helped them boost their earnings. The likes of BOA had tax credits that also give their earnings some boost. Danksem, unfortunately, did not have any things to more or less give that bottom line a boost, as companies concerned. But like I mentioned earlier, one common thing we see across players has been the pressure that the naira devaluation is having. So across the board, when you look at the energy mix for most of the cement players, have some gas, some gas. There's a usage of gas in the company. So with the valuation of the naira, you've had gas contracts just push up energy costs. And then also because you have to import system, all of that valuation is definitely some pressure on cost. And then we've seen the gross margins eroded compared to last year. But going into Q2, like you mentioned earlier, it's even though it's hard to more or less, when you even speak with management, you also see that that picture of, it's kind of hard to think what exactly to expect, considering it that happened before, but definitely it doesn't look on the positive, considering the lockdown, the interstate movement have shut down as well. So, movement of across the state also, have also halted to some significant extent. Definitely, we're expecting that pressure, as far as future is concerned. Likes of Dangote Cement, for instance, has the wider reach across other African countries. Also, considering it's not just a Nigerian issue as well. So, for Q2, we're definitely expecting some pressure. But when you have to look at trading in terms of how the stocks are trading at the moment, that the likes of BOA actually, is already trading, quite expensive in terms of PE compared to peers. So even though they have some stronger ROE compared to WAP, for instance, but the likes of banks to have that superior ROE that would not just by the PE, just in terms of market terms, but that's what is being across cement companies for now.